In this week's video, we'll review the latest charts to help us answer the question, will a Russia invasion kick off another sharp leg down in stocks? These bullet points applied on January 7th when we covered them. They applied coming into this week, and they will apply once again on Tuesday morning since the market is closed on Monday. Bullet point from the January 21st video, respect unfavorable environment until it improves. What does that mean? Well, that varies based on your time frame and your approach. Under our approach, that basically means every single week we need to make sure that we're aligned with the evidence. If we're not aligned with the evidence, we need to make an incremental adjustment to get ourselves back in line. Last week we covered the intermediate term tipping point on Friday, February 11th. Thus, it's not particularly shocking that the market struggled and were weak again this week. There's always no shortage of things to worry about in the stock market in the present day. There are numerous things to be concerned about, including Russia, inflation, and the Fed. For the most part, it's standard operating procedure for the Fed to try to jawbone interest rates up prior to their first hike. They've done a pretty good job of that here. You can see the 10-year yield, the beginning of the year down here, moved all the way up here. A lot of this movement from this point A to this point B is the market anticipating the interest rate hikes that are to come. Thus, that's important to keep in mind because even though the Fed hasn't started hiking rates yet, for the most part, the market's already taken it into account. So the rate hikes won't necessarily cause the market or 10-year yields to move from here to here. That's not a prediction, but there's no question the market tends to front run the Fed. And that's what's been happening. Still floating right around this key 2% level here, the 50% retracement in this area here. And we all know that interest rates and Fed policy are impacted by inflation expectations. You can pause your video player, but there's been some evidence in recent weeks that inflation may be showing some signs of taming a bit. A topic that we've covered in the past using this chart here. This is tips relative to standard treasuries. You can see momentum has calmed down quite a bit relative to last year. While it may seem hard to believe, by definition, the S&P 500 is experiencing a pullback. We still have not checked the box of a standard correction, which is a 10% drop on a closing basis. We've come close, but we're not quite there yet. This is where we stand as of the close on Friday, February 18th, relative to the 4 to 15% drawdown chart that we've been covering for several weeks now. And if you watch these videos on a regular basis, there's really nothing shocking here relative to a 9 to 10% drawdown that we've experienced. Back on January 14th, it probably seemed very logical that an 8 to 15% correction was well within historical norms. In the real world, it doesn't feel as logical when screens are red and balances are falling, but at this point, really haven't seen anything here that's particularly shocking. The S&P 500 on a closing basis here relative to the low that was made on a closing basis in January, market really hasn't shown a lot in here. And until something changes, we really have to assume that the base case is for more downside. That's not a prediction, but that's trading the chart in front of us from a shorter term perspective. Do we have any evidence in hand that tells us it's possible that this retest of the low will be successful? And it should be noted, a retest of the low, three major things can happen. You can print a low above this low, you can print a low that's basically identical to this low, or you can exceed this low. And even in that case where you exceed the low, you can still pass the test if you rally in relatively short order. Also want to make sure that the term retest doesn't imply that the market's going to hold. A retest speaks to potential support. Kind of a weak rally attempt up here relative to this high. It is good that we closed above this level here, and it's also somewhat encouraging that the VIX was tamed during Friday's session. It was down about 1.53% after the close, the 4 p.m. close on February 18th. And maybe more importantly now, on an intraday basis, we have a high, a lower high, and another lower high. This is where the VIX was intraday last time the market was down in this area. See, price is basically in the same place. And the VIX in the present day is quite a bit lower, especially this spike here. Doesn't predict anything, it just tells us to keep an open mind about the scenario where the market makes a stand in this general area in the coming days and weeks. Clients and regular viewers may remember several studies from last year told us it was possible that your maximum drawdown looking out a year, pretty good odds that this June low would hold. This was a study that was conducted in July, signal on July 2nd, and these were the hypothetical maximum one-year drawdowns. You can see we've come back to several of these levels here, really just reminding us that this area in here and this low here speaks to some type of probabilistic reference point. If we do continue to fall, it's just good to know where this is. There's nothing magical about it. Similar situation here, Nasdaq 100 futures Friday morning right before the market opened. The close was here. Similar situation. Closed about right here. We've got a reference point here, and we're still above these intraday lows. As always, we'll learn something if we move into this area here. The longer we stay down here, the more significant it would become. Also noteworthy on a lot of these charts, hypothetically, on this chart here, a lot of stops could be set right in this area here, which could create, on numerous charts, somewhat of an air pocket. All the stops execute, and then it's possible that the market reverses. Again, not a prediction, just good to be aware of where the stops may be and how they may impact intraday price action. Very, very similar situation here. This is a daily DeMark chart. DeMark charts are proprietary tools and indicators from Market Studies, LLC. S&P 500 at the close on Friday, above the January 24th intraday low. This is our close on Friday. We got a reference point here, a reference point here, and we're still in the vicinity of this gap, and maybe more importantly, still in the vicinity of the October lows back here. So this is your retest look. Right now, the retest is still in play. How long that remains, the market will make that call. There's really not a lot to get excited about in the short run. Here's something else. You can see price down in this general area here. We're in basically the same area now. See where RSI was down here, the first low in January, and here's RSI here. So you've got a little bit of a momentum divergence, another reason to say, hey, let's see what happens here. Keep an open mind about what this chart may look like a week from today. And how does the retest scenario and the divergence and the VIX come into play in terms of managing risk in our approach? It's the same as it always is. Have to make sure that we're aligned with the evidence here, or aligned with the evidence here, and aligned with the evidence here. It's an incremental process. All this allows us to do is to take into consideration that we've got some reference points close by relative to any move that we made on Friday. You still have to stay within striking distance of the evidence because that's how we manage risk. S&P 500 30-minute chart, somewhat of a mixed bag. This is not a good look here. Momentum, price is up here. Momentum is similar to down here. This looks a little bit better because now we have somewhat of a bullish divergence. Momentum is waning a little bit between these 2 points, and price is actually lower here. Nothing outstanding, but just something else that we can take into consideration relative to the probability of the market making a stand near these lows. Let's see a little bit better on the 60-minute chart. Some evidence of waning momentum. When we're down here, you can see momentum is here, here, and here, here, and here. Doesn't guarantee us anything. If you want to flip that around, the bulls haven't proven really anything. Here's momentum, a lower high, and a lower high. As always, when in doubt, refer to price. And price-wise, we're still in a range that started here. Here's the lower end of the range, and we're basically in the middle of the range. Price-wise, not really a good look relative to this short-term trend. There are a couple of positives here. One, the 200-day moving average in red has been acting somewhat like a magnet. What does that tell us? It tells us when we're down here, institutions were really not that motivated to sell. Could make the same argument up here. Institutions really weren't that motivated to buy. So this is a battle here, but the longer you can stay near that 200-day moving average, really the better in terms of having a probability or higher probabilities of the market bouncing. You can also see a divergence on the daily chart. Here's price, here's where we closed in basically the same area in here, and we do have a little bit of a momentum divergence on the daily chart. If we continue to fall, these dotted lines are based on fibs. So for example, the A to B move from the October low down here, this is the 38.2% retracement that comes in around here. Similar concepts here. These horizontal lines are based on gaps. Some reference points for the tech sector as well. Tech, here's the close on Friday. It was able to hold two things. Number one, it's still near this gap up from October. And number two, it did close above this October low. And that's the S&P 500 Tech Sector ETF XLK. If we were to look at growth, large cap growth ETFs, they're weaker, and QQQ would be weaker as well. So the charts look similar, but this one looks better. And for now, we also have that magnet look near the 200-day moving average. 200-day moving average still upward sloping. S&P 500 weekly relative to SP low volatility. Bollinger Bands get extended, S&P makes a stand, they get extended, makes a stand, get extended, S&P makes a stand, makes a stand. This is telling us to pay closer attention, but if you really look closely, typically when the market makes a stand, it gets somewhat of a V look to it. See how black here? Somewhat of a V look, somewhat of a V look. We don't really have that. We came out of it and then we're down. So you have to remember, it could be a look like this. You can pause your video player here. Similar concepts here. When the put-call ratio gets outside of the Bollinger Bands here, tells us things are getting a little bit extended, and sometimes, not always, that look can occur near major lows in the S&P 500. Let's take a look at credit spreads. These readings are as of February 16th. Here's the level this week. Spreads are much narrower than they were during the COVID spike. Spreads are still significantly narrower than they were in Q4 of 2018. Same can be said in Q1 of 2016. The S&P 500 has a correction from the spring of 2015 into early to mid-February of 2016. Think of this as fear, this, and this. And if we look at all of them relative to the financial crisis, it's very, very difficult to say that the credit markets, based on this reading on February 16th, are really all that concerned at this point. As we always say, it can change very, very quickly. But you have to keep in mind how long the market's been weak. Some of the weakness started in Q1 of last year, and at a minimum, even in the bigger indices, November of last year. The credit markets have had plenty of time to assess what's going on, and thus far, they remain relatively tame. Similar concepts here as of the close on February 18th. No big movement, holding above this level and holding above these levels here. You can pause your video player here. This is it's not really safe to make any assumptions about where we are. Are we here? Are we here? Or do we look more like this? If you know your market and economic history, you know a recession is involved here, recession involved here when the stock market plunges. This data speaks to recession odds. Compare the look here and the look here to the look in the present day. Similar situation with industrial production. Weakness in the market, a recession, weakness in the market, a recession, weakness in the market, a recession, weakness in the markets. This is what today looks like. It's a Nasdaq monthly, February 17th, around 2 p.m. Eastern Time. Compare this look here and this look here to the look in the present day. You can do the same thing with RSI relative to the present day. You could also make an argument that this congestion here is similar to this congestion here, and this push higher outside of the Bollinger Band here is similar to this push higher outside of the Bollinger Band. And it's very, very difficult to look at the Nasdaq here relative to the Bollinger Band here. And this goes all the way back almost over a year now, and say that it looks like this peak here in 2000. Notice when the market holds here, it bounces, it bounces. We really don't have that look here. This look here looks more like this look here in its present form. Doesn't mean we can't reverse here, but you're hugging. That's not really a good look. It's telling us to keep an open mind about more downside in the Nasdaq. And RSI down here is pushing that envelope that we talked about possibly a few weeks ago. Another thing to think about relative to risk management in tech stocks. Secular bull, Nasdaq above an upward sloping 200-week moving average. That's the good news. The bad news is we're very extended. So from a risk management perspective, if we came back closer to it, that could be a relatively significant drop. Weekly RSI, kind of a tweener look here, but we tried to retake 50. Couldn't do it. Prefer to see something more like this over here or this over here. That may happen. It just hasn't happened yet. You can pause your video player here, but all things being equal, you'd prefer to stay above these weekly moving averages, and when you drop below, the probabilities start to deteriorate. Here's a short stay below, and here's a short stay below. Just have to keep an eye on this over here as well. It's really important to see where this looks at the end of the month. As of the 18th in the morning, we were below that 10-month moving average. Keep in mind, when interest rates move rapidly, it's usually a reflection of a strong economy. So similar move in rates here. What happened in the stock market? Last time something similar happened, very good things happened in the stock market, longer term. You can see there is a drawdown here, shorter term. Talked about American Association of Individual Investors, bulls minus bears in a previous video. Here's a similar look this week from Sentiment Trader. You can pause your video player here. Average return 1 year later, 19.65%. Median return, 20.37%. 94% of the cases, the stock market was higher a year later. Pause your video player here. Nasdaq 50-day below the 200-day. I believe it went into the history books at the end of Friday's session. Once again, you can look at the numbers here, and if you know economic history, a lot of these are recessionary periods. So if you pull out the recessionary periods, when something similar happened in the past, the average gain a year later in the Nasdaq was 28% roughly. The median gain was 24%. If you look at all of the numbers here, 16% and 13%. Here's the source of this study. Anything else on the present day charts that tell us to keep an open mind about better than expected outcomes on the other side of this? It's a weekly chart, DeMark chart of XLK. It's a probabilistic magnet upside target. That's 30% higher than this level here during the trading session on Friday. Not a prediction, it just speaks to probabilities. If you want to take the bearish side of that argument, look how far away the upward sloping 200-week moving average is. This chart allows us to compare the present day to 2015 financial crisis and the dot-com bust. Also good to know these overextended looks can occur at the relatively early stages of a move, 1995. A very, very similar look can occur at the end of a move. NYSE advanced decline volume, present day this week, COVID plunge here. This is somewhat a double drop in 2015, 2016 in the S&P 500. Software stocks still floating around that 50% retracement. Not dead yet, but if they get into this area here, it would speak to probabilities. This is a strong push off here, relatively strong push here. This one doesn't look as good. Similar situation here. This doesn't look as good as this, but this period here tells us that just dropping below alone doesn't mean you're dead in the water. The broad Dow Jones Composite average has not broken down yet, really still in a trading range. Covered this chart in the past. Here's the look of it on February 17th. Nothing magical about this chart. Covered this chart last week. We did get a bounce look. This date on this chart's only printed once a week, so this is at the end of last week. We'll see what it looks like at the end of this week if we made a lower low. Remember we said the Nasdaq 100 or the triple Qs were weaker than XLK. You can see prices down here. It's well below that October gap and well below the October low here. Always good to have reference points. There's a 50% retracement from this low here in September up to this high here. It comes in here, and then the June low would be the other blue horizontal line here. And this would also fit into trigger all the stops, come down in this area, and possibly hold. Those are all hypothetical scenarios. The bias for this chart in the short run is for more downside until proven otherwise. NYSE Composite still in a range, no real breakdown here. Similar situation on the weekly chart. Secular bull market on the weekly chart, really not in jeopardy. That's the good news. The bad news is there's a lot of white space here, something we have to keep in mind. This is during the trading session on Friday. Until something changes here, this is not a good look. Moral of the story here, if the Nasdaq continues to fall, good to keep in mind that we're getting close to levels where major lows were made in the past. Doesn't mean we're going to hold, just good to have these reference points, especially something to check on after the close. Similar situation here. These are areas where the market made a stand in the past. You can see if you don't make a stand there, the odds of uglier declines ahead start to increase. Bad news. Ugly look for the stock market here early November. This is the beginning of the year. It was an ugly look for the stock market. Back to a similar area here. That would be the bad news. The good news is downward momentum is dissipating a little bit. Price, you could say, is retesting this low. But in terms of price, there's really nothing to get excited about here yet. The longer this stays below that 200-week moving average, the more concerning it would become. Really nothing to get excited about here yet. And why this is relevant. See how long this has been declining? It reminds us it's not safe to assume that something like this has to happen. And the decline in ARC tells us we have to be open to this chart getting a lot uglier as well. That's not a prediction. It's just something you have to be aware of. And XLK and large cap tech was really the last to survive. And ARC is also telling us not to assume anything about what's going to happen here either. You can pause your video player here. Nothing earth-shattering here. It's more observational, anecdotal. Here and here were inflection points for XLK relative to SPY, inflection. It's possible we're coming back to a similar area. And about the mirror image here for XLE energy relative to SPY and XLE energy relative to SPY. Again, nothing earth-shattering. If this were to break out, you would think it would be better for energy. If it were to bounce down like this, you would think on a relative basis it would be better for tech. High beta stocks, what does this say about the economy? Held here, held here, held here. On the retest, we're not even near that line at this point. Very similar comments here. Still in a range. Compare this look up here to the COVID plunge look over here. Ditto. Compare this look to the COVID plunge look. Same concepts here. Holding up relatively well. This speaks to economic fear. Same concepts apply here. Still holding up. Didn't hold up. Stock market, things got ugly. Couple points here. If this is the head and shoulders topping pattern that could be forming in the S&P 500, just remember this neckline area in here, you might get a lot of stops in this area here. And below that hypothetical neckline, because we don't know if this is a head and shoulders top or not, right below it is that June low here. All of these areas relative to past resistance and past support could act as potential support down here. A similar situation here. Stocks relative to gold have come back here. You can see it a little easier on the smaller chart. Long-term consolidation 2018. We get the breakout last year, and now we're back to that level. We'll learn something if we move this way or if we plunge in this direction. Market leadership battles, really nothing decided on most of those charts. Energy is your clear, unequivocal leader in the short to intermediate term. However, there's a lot of charts like this that tell us it's got a lot of work to do from a longer-term perspective. Value versus growth. Another look at value versus growth during Friday's session. The value has been very, very strong since this low here in late November, but it's still in a range relative to the S&P 500 or VU. If large cap tech is going to be the last to fall in the sector, then this could get ugly and we have to be prepared for that. But right now, the last thing this did was make a new all-time high, and right now we're still hovering around the 50% retracement of this A to B move. There's a longer-term look at tech XLK relative to the S&P 500. Really, this is a range in here. We're back in that range. We had a failed bearish breakdown here, and then we came back into the range. Here we have a failed bullish breakout, and we're back in the same range. This is Amazon relative to the S&P 500. This is the spike up. This is the outperformance, the stay-at-home trade. All of that outperformance has been given back. We held at that gap thus far. We'll learn something in this area here. And keep in mind, both Amazon and the S&P 500 have done well since this point. This is relative performance. GDX during Friday's session. S&P 100 index, some possible reference points. Stocks versus bonds. This is the high fear COVID look. Present day, we're really still consolidating. The last thing we did was make a new high here. Similar situation here. This very, very long-term chart is still holding that breakout as of February 17th. Compare and contrast with the dot-com bust bear market here, the financial crisis bear market here, and this is what we have in the rearview mirror looking backwards in 2022. Stocks versus bonds here, weekly momentum trying to turn back up. It's at least flattening out above the zero line. When indices or ratios are in ranges, we have to balance the desire to protect capital with the desire to minimize the number of whipsaws. Pause your video player here. This speaks to valuations that have come back to more attractive and realistic levels. This is a topic we've been talking about numerous times in recent weeks and months. You can read this up here, but it's basically saying drawdowns or full year performance tends to be much, much better when you avoid a recession. And if you remember the demographic video, that stuff's still in play. Remember we talked about 2034, 2035, 2038. This is a very, very similar demographic-based model here. Always want to be thinking about the other side of this while we're in the decline. Still have to manage risk. Last week's video had the word fail in the title. We were down again this week. These bullet points still apply. Haven't seen anything significant on the thrust front yet. To summarize, we're currently experiencing a retest of the January 24th lows in most positions. Some positives. During Friday's session, there was some buying near the previous lows or above the previous lows. We do have some improving looks on shorter-term charts and some daily charts from a momentum perspective. The VIX, the intraday high today, was quite a bit lower than the intraday high back in late January. And thus far, the 200-day moving average on a lot of our positions is still acting as a magnet. Other than some of these items that we've covered, we really don't have a lot to talk about on a short-term basis from a positive perspective. Now, just as things flipped very, very quickly in a bearish manner, have to keep in mind, just because we haven't seen a whole lot yet have to remain very, very nimble. The short-term trend unequivocally still remains down. We'll continue to do what we've been doing. Stay aligned with the data. Make sure we don't drift too far from it, even when we're in a range. And that nimbleness speaks to being open to redeploying capital rapidly if you see what you want to see. There's nothing binary about that either. It's a weight of the evidence approach. And we all know the only way any of this works, we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.